Yes, guys. Yes, better. So, guys, the first thing that I told you that is national income accounting better dealt with post ex post values. That is, we were accounting better after the events have actually occurred. But this chapter better deals with estimate expenditures as such, guys. Estimate supply, estimate demand, which are ex ante values. That is the very first thing that you should know better about this particular topic. That is Keynesian theory of determination of national income. In this chapter, guys, we would be talking about a two sector model, a three sector model, and a four sector model. Two sector beta covers your household sector, guys, and the business sector. A three sector model beta covers household sector, business sector, guys, as well as the government sector. And the four sector model beta covers household, business, government beta, as well as the external sector. Only a four sector model is an open economy beta. Two sector and three sector models are termed as closed economies because we are not open to trade as such beta to outsiders. We are not open to trade to outsiders. As far as circular flow beta in a two sector model is concerned, guys, in a two sector model, in a circular flow beta, I told you that whatever is the amount of quantity of goods as such beta that the producers manufacture as such, guys, producers manufacture, the value of that as such beta is in turn passed on to the household sector, guys, in the form of factor payments. In the form of factor payments beta, that becomes your national income. And guys, the households as such beta would in turn spend this amount as such, guys, to buy goods and services that have been manufactured by the firms, and that is your consumption expenditure. If there are no leakages, if there are no injections as such, guys, your Y beta would be simply equal to C. Y beta, national income beta, would be equal to your consumption expenditure. In a two sector model beta circular flow, guys, this hypothetical situation, we are assuming, guys, that there is no amount, there's no government, there's no external sector, there are no taxes, there are no transfer payments. The prices will not change as such, guys, including factor prices. Technology is constant. The only way beta that you change output beta is by changing the employment level, ठीक है बेटा. Yes, so this is what we wrote, guys, here. Y is equal to C, wherein the total factor payments as such beta, which is household income, will be equal to household expenditure, which will be equal to the receipts of firms, which would be equal to the value of output that they manufacture. After that beta, I told you the meaning of the word equilibrium output. So equilibrium output beta is that output level as such, guys, where the planned expenditures, guys, of the consumers match with the planned production plans beta of the firms. So aggregate demand beta should be equal to your aggregate supply. That is equilibrium output. Now there's no compulsion beta that equilibrium output beta should occur at the natural level of real GDP. That is the point where all the resources of the nation are fully utilized. Not necessary that it should result at full employment level. As per your classical economist as such beta, the equilibrium level as such, guys, will always occur at the full employment level. The markets are self-sustaining, guys. Government does not have to intervene. They will automatically adjust, though there will be temporary deviations from the natural level of real GDP, but then there is enough price and wage flexibility as such, guys, that they will come back to your natural level. But as per Keynesian economists as such, guys, the Keynesian theory, markets are not self-sustaining. Government has to intervene as such, guys. The equilibrium position will happily settle as such beta at a level lower than the full employment level beta, which will result in unemployment. Now this problem cannot be solved unless government intervenes as such, guys, and takes care of the deficient demand, or beta there's an actual increase in spending by the consumers. I gave you an example beta, say by using all the employees, by using all the people, if you can manufacture 1500 units, but equilibrium is occurring only at, say beta, equilibrium beta is occurring at 1200 units, and it is not occurring beta at full employment level. Understood? Yes, sir. After that beta, we moved on to the basic concepts. I told you what is the aggregate demand function. This aggregate demand function beta has evolved during the entire chapter, guys. Initially beta, in a two sector model, aggregate demand is the total planned expenditure, guys. It is ex ante demand. Demand is such beta for final goods and services. So that will be demand for consumer goods, demand for investment goods. Point to be noted beta is that AD is equal to C plus I is constant, guys. Now you will, because I is constant beta, let us concentrate on C, that is consumption function. Consumption function beta is a relationship between your aggregate consumption and aggregate disposable income. Even if your undoubtedly beta, the amount that you consume will depend upon the income. It will depend upon the income. Here we are not referring to income of one individual. Here we are referring to income of the entire nation. Income of the entire nation. This is macroeconomics. This is not microeconomics. So here beta, even if the income levels are zero as such guys, there'll be some amount of consumption expenditure guys, that is to satisfy your basic necessities as such beta, which will either be out of your past savings or by borrowing money. And so that is why beta that is considered as A, autonomous consumption expenditure. Then beta B into Y. B here beta is marginal propensity to consume. What would be your incremental consumption with an increase in income as such guys, with an increase in income. So yes, your total consumption has two components. One is autonomous consumption expenditure, one is induced consumption expenditure, which is B into Y. B is the slope as such guys. The best part about this chapter beta is that B is assumed to be constant. In reality B does not remain constant. In reality beta B does not remain constant, but this chapter assumes that B is constant. Yes sir. Now guys, what you will have to understand beta is, using this is marginal propensity to consume, that is change in income, change in consumption expenditure divided by change in income guys, change in income. Marginal propensity to consume as such beta will lie between 0 and 1 as per Keynes as such beta, John Maynard Keynes. The value should lie somewhere between 0.5 to 1 guys. Average propensity to consume is your total consumption expenditure beta divided by total income, divided by total income. Now this average propensity to consume as such beta can be beta your positive infinity, and as the income levels are increasing as such beta, it will reduce and be a number lesser than 1. But initially beta, even when the income levels are 0, remember you're consuming something, so that is what will result in average propensity to consume beta to be positive infinity. And then beta, what is not being consumed as such beta is being saved. So yes, you can say your national income is equal to consumption plus savings. Saving income function beta can be derived out of that, and I wrote it as minus A plus 1 minus B into Y, 1 minus B into Y. Using saving function, initially beta there'll be dis savings. Matlab beta, when the income levels are 0, you have negative savings. Gradually as the income level increases beta, savings will be 0, and then beta after that beta, savings will be positive. We will learn later beta that we will want our savings beta to match with investment expenditure. That is equilibrium output level beta, which we'll talk later. So guys, marginal propensity to save beta is 1 minus MPC. Marginal propensity to save beta is 1 minus MPC, that is 1 minus marginal propensity to consume as such guys. Or you can also write as incremental savings divided by incremental income. Average propensity to save beta is total savings divided by total income. This can range from negative infinity as such beta to slowly it will increase, go above 0 as such beta. And then guys, aggregate supply is nothing but the total planned supply as such guys. Whatever the firms are manufacturing as such beta, that in turn will result in factor payments to the household sectors. So we can say beta that the total planned supply guys will be equal to the incomes of the household beta. That is why it is consumption plus savings, consumption plus savings. So aggregate supply is the amount of national income, that is consumption plus savings. Understood sir? I gave an example to compute MPC, to compute MPS, APC, APS guys. Then beta, we moved on to a two-sector model of national income, which has only a household sector guys and the production center guys, production sector. So in a two-sector model beta, at equilibrium level of output, we want our aggregate demand to match with aggregate supply. Aggregate demand to match with aggregate supply beta, that is C plus I should match with C plus S. Please do not forget beta that savings can change with income, but then we are assuming that investment is constant. The amount of investment that the business firms are going to make beta is assumed to be constant in the short run. So that equilibrium position will achieve beta basically where C plus I is equal to C plus S, or indirectly beta savings should be equal to the amount of investment. Ye dekho beta, savings should be equal to the amount of investment as depicted by this graph. That is where beta equilibrium position will occur. Equilibrium position will occur. Okay? See guys, you should obviously have beta no reasons to believe that the consumption plan should always match as such beta with the production plan, and the producer's plan to invest beta should match with savings plan. This is where beta your aggregate demand can be less than aggregate supply, or it can be more than aggregate supply. If aggregate demand as such beta is less than aggregate supply, if aggregate demand is less than aggregate supply, the inventory levels will increase. With an increase in inventory levels as such beta, the suppliers, the producers will start reducing the manufacturing activity. Gradually supply beta will come down to the level of aggregate demand and equilibrium position. Likewise, if aggregate demand as such beta is greater than aggregate supply as such beta, this will result in reduction of inventories, and the suppliers will slowly start to increase their inventory levels, and this will result in an equilibrium position. Equilibrium position. Understood sir? Here beta, we write our national income beta as C plus I. We write our national income beta as C plus I beta, where C is A plus BY. A plus BY. At this point beta, we also spoke about leakages and injections beta under a two-sector model. Under a two-sector model, the only leakage, that is outflow of income, is in the form of savings. The only injection beta is in the form of investment, that is inflow of income. You would want beta your savings to exactly match with the amount of investment at equilibrium level. You will want your savings to exactly match with the amount of investment beta at the equilibrium level. Understood, sir? Then we spoke about equilibrium level beta, which is not equal to the natural level of real GDP. That is where it will result in either unemployment or inflation. Two situations, guys. Either your equilibrium level beta is greater than the aggregate demand level, or it is lesser than the aggregate demand level. Usually it is lesser than aggregate demand level. If it is lesser than aggregate demand level as such beta, we term this as deflationary gap, recessionary gap, contractionary gap, results in a recession phase as such beta on account of deficient demand, results in cyclical unemployment. Obviously, guys, the aggregate demand is less. If the consumers are still operating at full employment level, it will result in higher amount of inventories. They will want to cut down on inventories as such beta. For that beta, they will again, guys, reach the aggregate demand level. So it will result in some amount of unemployment. Inflationary gap on the other side beta is where the demand is more than what the nation can actually produce. In this case as such, guys, what will happen beta is that there will be an increase in nominal output, not real output. Your real output remains constant. You cannot increase the number of units manufactured. This will result in inflation, guys. Inflation. Understood, sir? So this is where beta I told you. I gave an example, guys. Here, clear understanding ke liye. Do not forget beta. This is just a quick revision. You still have to go through all of this. I spoke about a shift of aggregate demand, guys. I said beta your total aggregate demand is C plus I beta. C again comprises of an autonomous consumption expenditure and induced consumption expenditure. If autonomous consumption expenditure is increasing, guys, overall aggregate demand is increasing, still national income is increasing. If induced consumption expenditure is increasing beta through a rise in marginal propensity to consume, again beta overall national income will increase. Overall national income will increase as such, guys. Okay? But then beta this only talks about the direction in which the national income is moving. If you want to know the exact impact on national income, we have to compute something called as the multiplier effect. Multiplier effect beta will measure as to what would be the impact on your national income for every rupee increase in the amount of investment. If investment increases by 1 rupee, what would be the impact on the national income? Do not forget beta, if investment is increasing by 1 rupee, national income is increasing by 1 rupee, that 1 rupee in turn will result in consumption expenditure, that in turn will result in increase in national income. It creates a ripple effect. So we write beta multiplier effect as 1 divided by 1 minus MPC. 1 divided by 1 minus B. Higher the value of MPC, higher the multiplier. Lesser the value of MPC, lesser the multiplier. I gave you different examples beta to prove as to how will you compute your investment multiplier. It is 1 divided by 1 minus B. A lot of examples were discussed beta in the class. Ripple effect sab padhaya beta tumhare ko main. Then I told you guys that increase in investment will not continuously result in an increase in income beta. This has to stop somewhere, and this is due to leakages. Leakages can be due to progressive taxes beta, higher amount of import, scarcity of goods as such, guys. There is idle cash lying as such beta. People are using it to buy existing wealth. People are using it to repay debts as such beta, and or pure ho gaye. Haan. There are undistributed profits as such, guys. The economy is already operating at full employment resulting in inflation. So not always beta the multiplier effect will work, guys, indefinitely. And then, guys, underdeveloped economies have a very high amount of marginal propensity to consume. So logically beta they're supposed to have a very high amount of multiplier effect, guys, multiplier effect, but in reality they do not have a higher multiplier effect. That is because, guys, they have structural deficiencies. Even if the amount of national income is increasing as such, guys, the production is not increased as such, guys, and this will result in inflationary pressure. Understood, sir? Keynesian theory is not applicable beta to compare national incomes at different points of time. It is applicable only for short period. Keynesian theory has their own drawbacks as such, guys. So boss, we spoke about inflationary deflationary gap, we spoke about investment multiplier, we spoke about Keynesian theory under a two sector model where your national income is equal to C plus I, guys. Now determination of national income under three sector beta, this is where we introduce government sector. Government beta will collect taxes beta from households, will collect taxes from the corporates. Government will provide subsidies as such, guys, to the business sector. It will also give certain amount of transfer payments to households. Government will buy goods and services beta from the business sector. It will hire factors of production, guys, from the household sector. Government will borrow money if there's a deficit, guys, if there's a deficit in their spending. Understood, sir? And then beta your aggregate demand will now comprise of three parts. There is consumption expenditure, there is investment, there is government purchases. For the sake of simplicity beta, here G is assumed to be constant, I is assumed to be constant. Investment is still constant, G is still constant, guys. So in a three sector model, now there's an additional leakage, guys. Leakage beta in the form of taxes. We already had a leakage in the form of savings. Now we have leakage in the form of taxes, guys. and injection as such beta is in the form of government purchases. In the form of government purchases, we already had injection in the form of investment. So if you want the equilibrium position as such, guys, you will want C plus I plus G to be equal to C plus S plus T. C plus S plus T, guys. That is, you would want your aggregate demand to be equal to your aggregate supply. That is why beta we write national income under a 3-sector model beta as C plus I plus G. C plus I plus G. Here beta, for determination of income, we divided them into 4 cases beta. What if the government is levying a lump sum tax? That will reduce the amount of disposable income, guys. We will write YD as Y minus capital T. What if the government is imposing tax as a percentage of income, guys? So that would be, you know, guys, lump sum tax beta and transfer payments, sorry. So if there's lump sum tax and transfer payments, minus T plus TR, guys, to your national income. And then what if there's a tax as a function of income? Small t into y beta. What if there is tax as a rate of income as well as transfer payments? YD beta is equal to total national income minus lump sum tax minus tax as a percentage of income plus transfer receipts. Ultimately, you should know how much money is in the hands of individuals beta that they can spend. What is the money in the hands of individuals beta that they can be spending? Here beta, you should know what is the tax multiplier as such, guys. If there is only lump sum tax, multiplier remains same. However, if there is tax levied as a percentage of income, guys, remember every time there's an income generated, a part of the money is going to government, but government spending is remaining constant as per the formula. So there are drawbacks in the formula, guys. Actually, when the amount of tax revenues of the government increase, government spending should also increase. But then that is a drawback here beta. So as the amount of tax beta is going to the government, that is the leakage is increasing as such, guys, injection is remaining constant. Obviously the multiplier effect will reduce. So if there are taxes levied as a percentage of income, guys, multiplier is 1 divided by 1 minus B into 1 minus T. B into 1 minus T. Understood, sir? I gave you example to make you understand all of that. Then I told you beta, balanced budget is where the government spending is equal to tax revenues. Surplus beta is the revenue is more than government spending, and there's a deficit if the revenues are less than government spending. ठीक है? Yes, sir. Government can always try to increase. Government can always try to increase the total national income levels as such, guys, and try to achieve the natural level of real GDP, guys, by spending more. By spending more. Then finally beta, we moved on to the 4-sector model. This is where we have introduced external sector, guys. Here there's an additional leakage beta coming in the form of imports. There's an additional injection in the form of exports. We assume exports beta to be independent of our income. So exports are constant. Investment was already constant. Government purchases was already constant. Imports beta will have 2 components. One is beta autonomous import expenditure that does not depend on the amount of income that you are generating, and the other one beta is depending on marginal propensity to import. So we write capital M bar plus M into Y. Both beta. There's an autonomous import component plus beta there is imports that also depend on the amount of income that you are generating. Understood, sir? So यहाँ पे beta, you will have to be careful here. Aggregate demand beta will comprise of not only consumption, investment, government purchases, but also net exports wise, that is X minus M. X minus M, guys. You'll have to be careful regarding the formulas. Your multiplier beta will get affected. It will be 1 divided by 1 minus B plus M. 1 minus B plus M. Because beta your part of the income is going out of the country beta in the form of imports, guys, the multiplier effect will reduce. Multiplier effect will reduce, guys. Understood, sir? After that beta, I told you that if your marginal propensity to consume is high, undoubtedly your multiplier is high. If your marginal propensity to consume, import is high beta, multiplier will be low. And then if your net exports are positive, national income increases. If net exports are negative, guys, national income will reduce. And trade balance beta is where you compare exports with imports beta, and exports are equal to your imports. ठीक है? Yes, sir. Never ever assume beta that exports are good, imports are bad and all of that, guys, because we want a proper allocation of world resources. ठीक है? We are thinking from the viewpoint of country, but ultimately, guys, we would want a proper allocation of world resources. Understood? The formulas that we have learned in this chapter beta is first aggregate demand function in 2-sector model. In 2-sector model, guys, aggregate demand. We have learned that as beta C plus I. Your consumption function beta, function of income beta, we have learned that as A plus B into Y, guys. A is autonomous consumption expenditure. A is autonomous consumption expenditure, guys. क्या क्या पढ़े बेटा चैप्टर में. And B beta is your marginal propensity to consume. ठीक है? No taxes, guys, so Y is equal to YD. And then beta marginal propensity to consume as such, guys, is change in consumption expenditure divided by change in national income, not change in I beta, change in national income. So MPC lies beta between 0 and 1. And then average propensity to consume is total consumption expenditure beta by total Y. APC as such beta would be from positive infinity, slowly it will reduce. And then beta savings is also a function of y beta, written as minus a beta plus 1 minus b into y. Your marginal propensity to save as such beta would be change in savings divided by change in income. Average propensity to save beta would be savings by income, guys. An aggregate supply as such beta should be the value of output that is equal to factor incomes. Value of output as such beta that is equal to factor incomes, and that factor incomes beta in a two sector model beta would directly be equal to consumption plus savings. Consumption plus savings, right sir? Right, these are the basic formulas that we have learned first, guys. And then beta I told you that in a two sector model, summary of two sector model as such beta, you would want your national income to be equal to c plus I, guys. I is constant as such, guys. Remember beta, the leakage is in the form of savings. Leakage is savings as such, guys, and injection as such beta is investment, guys. ठीक है? Yes sir. And your multiplier guys, k is equal to 1 divided by 1 minus b, guys. 1 minus b. This is what we have learned here, guys. Nothing else as such, guys. And then beta in a three sector model, as such, guys, you would want the national income to be equal to c plus I plus g, guys. C plus I plus g. Remember guys, I and g are constants, guys. And then guys, your leakage as such beta is in the form of savings and taxes. Your injections as such, guys, are in the form of investments and government purchases. Your disposable income beta would be y minus lump sum tax minus t into y plus tr. Any combination can arise as such beta. Your multiplier k beta would be equal to 1 minus b beta if there's only lump sum tax, only. Or it will be 1 minus b into 1 minus tax rate if its tax is as a function of income. Understood sir? This is a three sector model. Of course beta iske beech mein we have learned about inflationary gap, deflationary gap, but formulas पढ़ा रहा हूँ, guys. Under a four sector model as such, guys, remember guys, अरे आना भाई, क्या हुआ? Four sector model, your national income beta will be c plus I plus g plus x minus m, guys. Please understand beta, here I, g and x are constant. Beta, and your imports m beta would be equal to m bar beta plus m into y, guys. Imports beta would be equal to m bar plus m into y, and your disposable income beta, same rules will apply. They can be taxes as a percentage of income or whatnot, guys. Transfer receipts, all of this beta can arise. So here beta, your multiplier k as such beta, foreign trade multiplier जिसको बोलते हैं beta, that as such, guys, would be 1 divided by 1 minus b plus m, guys, and if there are taxes, 1 divided by b into 1 minus tax rate beta plus m. Please understand beta, the leakages in a four sector model beta are savings, then beta there are taxes, and finally there are imports. And guys, there are injections as such, guys, in a four sector model as such beta is investment. For taxes we have government spending, यहाँ पे भी लिखा ना government spending, government purchases. And then guys, there are exports. ठीक है? Yes sir. Apart from all of this as such, guys, when you talk about government का क्या है beta, what is the word that they use, guys, for government? Balanced budget. You can talk about balanced budget, guys. Balanced budget is where tax revenue is equal to the amount of government spending, guys. इसके अलावा as such beta, there can be budget deficit. There can always be a budget deficit, guys, and there can always be a budget surplus. वैसा ही बेटा foreign trade deficit भी करते हैं, foreign trade balance भी होता है बेटा. And then guys, we also spoke about trade balance. Yes or no? Yes sir. These are all the formulas that we have learned in this chapter, guys. I will zoom in as such, guys. You pause and copy. All of you beta can pause and copy this. ठीक है? Yes sir. All of you beta can pause and copy this. 1, 2 and 3. Pause and copy if you want to, guys. If you want to pause and copy, please do it. Here guys, please pause and copy. Remember, in a two sector model there are no taxes, guys. Pause and copy, guys. Here guys, pause and copy beta. Finally, pause and copy. Guys. Here guys, pause and copy. pause and copy, 4 sector model. Last one beta, pause and copy. I hope everyone has understood this better. ठीक है, I'll continue in the next session guys. We'll finish off all the problems, do not worry guys. It might take a little more than 3 hours better, because we do have a lot of problems that needs to be practiced. But do not forget guys that on an average as such beta 5 marks ke problems beta comes in the examination. There are instances beta problems being asked for 7 marks as well. If they ask for 5 marks, they might ask a 2 marker theory as well guys. But this chapter beta, second chapter, first unit, second unit jo open kare beta collectively will fetch bare minimum 12 marks in the exam. Bare minimum 12 marks. Obviously beta there are only 4 chapters as such guys. You can expect the weightage of this to be 14 marks, and I will want you to score 14 on 14 in this. Very scoring chapter beta, very scoring chapter. ठीक है guys, चलो बेटा, bye bye, see you guys in the next class. Keep studying, keep revising as such guys. Bye bye.